When it comes to mutual fund investing, in the past, people have gravitated towards specific fund managers, the so-called star fund managers. In today's context, you would talk about somebody like Rajiv Thakkar of Parag Parikh Flexi Cap Fund or an S. Narain. And you'd be forgiven for gravitating towards them because they've got a storied history, a legacy. But the question that we're asking today is how important is the fund manager in the larger scheme of things, and what should you do if the fund manager of the fund that you've invested in changes? Does that affect the performance of the scheme? Has it in the past? We'll talk about all of that on this particular chat. I'm joined today by Harsh Kumar, who's a managing partner and co-founder of Zvest Financial Services. Harsh, thanks so much for taking the time. First questions first. And Happy New Year to you. How important in today's context is the fund manager?
Alex, Happy New Year to you and all the viewers. Let's set the context first. At the beginning of the millennium, in the year 2000, the AUM of the mutual fund industry was around 1 lakh crore. And out of this, one mutual fund house, which is UTI, used to dominate around 60 to 65% of the assets. Come to year 2010 and 2014, the AUM increased to 10 lakh crore. But from 2014 till 2025, the growth has been exponential at the rate of 20% per annum. We ended 2025 with an AUM of 81 lakh crore. Now we have fund managers which manage more than 1 lakh crore, and there are close to 500 fund managers in the industry. Now, when you see such a huge growth in any industry, you're bound to see changes. And within the mutual fund industry also, we have seen a lot of changes, and fund management is also a part of this. Now, from a system of star-based fund manager, now we are looking at system-based fund manager. From intuition-based decisions, now these are institutional-based decisions. So, if I have to give you an analogy, in the year 2000, 2010, the fund manager used to be a chef running his own kitchen, and his temperament used to decide what the food would be at the end of the day in the table. But now it's all like a modern kitchen process where it's not one individual, but a team of experts supporting that individual, which help take the decisions. Now, having said that, I would not say that fund managers are not important. There are fund managers in the industry who are visionaries, who think laterally, who have a way of thinking which is beyond most of the other fund managers in the industry. You named a few examples like Rajiv Thakkar of Parag Parikh, Naren in ICICI, Vasan in SBI Mutual Fund, Chirag in HDFC. Now, these are the guys who are important to the system, despite system being very, very strong. But most of the fund houses over a period of time have institutionalized things. And today, if you look at fund manager, where you have more active fund manager still matters the most, but where you have more of benchmark hugging portfolio, still you can say that the team justifies the job which the mutual fund manager is doing.
Yeah, and the research desks are also fuller than they were even a decade back. The bench strength of fund managers is also larger. So it's a more collaborative effort that is involved in selection of schemes. But let's talk about the last decade perhaps, and talk about a few of the notable exits. A lot of the star fund managers of years past have actually ventured out and started their own firms, haven't they?
Yes. So let's see first the reasons why you would have an exit from a fund. Now there are 3, 4 reasons. First reason is within the fund house, fund manager is being promoted, or the fund manager moves to manage different schemes. That is fairly well accepted because that is a career progression for the fund manager. Then there are instances where, let's say, a fund manager retires, which is also well accepted. Third is a situation where the fund manager leaves and joins a competitor. Now, that is something which an investor needs to watch closely. And the last is, which is the current trend, where a lot of fund managers have left and started on their own as well. Now, to give you a few examples in the last decade or so, where we have seen some fund managers leave, say the notable amongst them has been Prashant Jain. He was in HDFC AMC for 28 years, and he was the CIO for 19 years. He was one of the longest serving CIO. And definitely when he moved out, industry was to keep a close watch on that. He started on his own. We had Kenneth from IDFC Mutual Fund. He left and he started Pine Bridge. We had Sunil Singhania, who left Nippon and started Abacus. We have recently seen Pankaj Tibrewal, who left Kotak and started Ikigai. Then we had Gopal Agarwal, who left Mirai. He didn't start on his own. He moved to DSP, and from DSP, he moved to HDFC. And recently, in December 2025, we had Roshi Jain, who was a senior fund manager of HDFC. She left. Now, most of the names which I have mentioned here are either CIOs or senior fund managers, and many of them have started on their own. And yes, I concur to what you're saying that the trend is that, if you are a star fund manager, you can start on your own and assets would flow to you.
Yeah, and invariably the course has been, particularly in one of the names that you mentioned, Kenneth and Old Bridge Capital, they've started off with a service and then moved to the mutual fund space. So that seems to be the trajectory as well. You start with a PMS or maybe an AIF and then you move towards the mutual fund space. But the question, and ultimately the most important point to the retail investor, to our audience here, Harsh, is does it matter for me if a fund manager exits? Has that proven to be negative for the fund performance?
Okay, so the first point for the investors is that, like I mentioned at the beginning, there are close to 500 fund managers in the industry. Now, when you have this high a base, even if 5% fund managers leave in a given year, you're looking at 25 fund managers leaving, and that can look to an individual investor to be a very significant number. But since the base is increasing, that's bound to happen. Now, looking at the exits, I would not want to go into all the exits because that would the time would not permit. But let me take 2, 3 examples from last 5, 7 years, and I would try to take both the examples where the fund managers continue performing, funds continued performing, and where the performance did not live up to the mark. So first is, let's take an example of HDFC. Now, Prashant Jain, like I mentioned, was in HDFC for 28 years. He was managing 3 funds: HDFC Flexi Cap, Large Cap, and Balanced Advantage Fund. And it's not that he didn't have periods of underperformance. There was a period from 2017 to 2020 when the market depth was very, very narrow. And I think you would remember, and the audience would also remember, the era of Ritik stocks, where all these HDFC, Reliance, ICICI, and Kotak, they were only running. And at that point of time, Prashant Jain had a phase of underperformance. But towards the end of his career, when he left HDFC, the performance of his fund was very envious. And for the entire tenure that he managed these funds, most of these funds, rather all these funds had benchmark beating performance in late teens, which is something which is very, very rare. Now, after he moved out, his funds were distributed across 3 different fund managers. And from a style which was a very deep value style and concentrated style, the new fund managers moved more towards diversified and balanced approach. Though the time period is very, very small, I mean, 2, 3 years is not a time frame for us to judge the performance of the new fund managers, but the performance has really been continuing and investors would not have any complaints about it. Now, let's move to the next one, Sunil Singhania. Sunil Singhania is known for fundamental stock picks. His primary strength is mid cap and small cap. In fact, he's closely related to Reliance Growth Fund. Whenever people talk about Sunil Singhania, they talk about Growth Fund, which grew in 22 years, it grew 100x. Now, he was also, concentrated stock picker, fundamental guy. When he moved out, at the same time, after, not after a brief period, Reliance stopped being Reliance and it became Nippon Asset Management. And since Japanese are very obsessed about processes, not just the funds which were managed by Sunil Singhania, but all the funds in Nippon now have fund casing. They have benchmark deviation rules as to how far they can go from benchmark. There is a lot of focus on what calls the fund manager cannot take. And the performance in these funds have also been continuing. So again, no complaints from the investors. Third is a scenario where I would take an example where the performance lacked a bit. And here I'm talking about IDFC, which is now Bandhan. Kenneth used to manage Premier Equity Fund. And he had a very unique style of managing where he would buy and hold stocks for a very long period of time. He was not concerned too much about taking stocks which were from the benchmark. And at times he was also okay with not having position which his peers were having. Now, when he left, there are a lot of changes which happened in the fund house because the fund house, like Reliance, became Nippon. This fund house became Bandhan. But at a fund management level of the fund, also there were a lot of changes, and that's the reason we have seen. The alpha in the fund, which is now a flexicap fund, shrinking. The fund has now become very cyclical. It is not a very differentiated fund, what it used to be during Kenneth's time. So I would say that more than the fund manager leaving, it's about how the transition is managed that decides how things go in future.
Okay, and we're out of time, but I'm still going to ask you this because this is the most important point. Harsh, what period, in your opinion, is justifiable for an investor to wait to look at this transition? Is it 6 months? Is it 1 year? Is it more? And when do you pull the plug? When you pull the plug, is it a wholesale exit or is it incrementally shifting to something else?
So Alex, this is a very important question. If I can take 2 minutes,
Yes.
there are three elements to this question. One is the fund manager who's leaving. So investors should look at whether that fund manager was the process or was a part of the process, which means how dependent was the fund on that particular fund manager. So typically for a fund house which has a large analyst team where the research is very broad based, there I think investors can stay put for some time. But where it's a very idiosyncratic fund where the fund house is very small, maybe investors need to look at close watch at that. Second is the new fund manager. If the new fund manager is coming from the same fund house, then the research philosophy and everything is same. Investors can stay put. But where the new fund house is coming from a different part of the business, where he has not managed the similar stocks or similar sectors, then maybe investors need to keep a watch on that. Third is the fund house itself. If a one fund manager or two fund managers are leaving in a year, it's fine. But if you see multiple fund managers leaving, if you see top management changing, then you need to keep a close watch at that. To give you time frame, this business is like orchard, where if one gardener leave, it doesn't mean that the next day the trees will start coming. One needs to give a decent time frame for 1 or 2 seasons to go through to figure out the performance of the next fund manager. But in my sense, first 6 to 12 months after a transition are just about clearing the fund in the way the fund manager would want. 12 to 24 months, you would see the style of the fund manager coming into picture. But after 24 months, you would start seeing the performance of the fund being reflected by the effort of the new fund manager. So ideally, if you don't have any red signal, which I mentioned on a qualitative part, maybe you should stay put for at least 2 to 3 years before taking a decision on what needs to be done.
Fantastic. All right. On that note, Harsh, thanks so much for joining in. Pleasure speaking with you.
Thank you, Alex. Thanks a lot.
And that brings us to the end of this edition of Your Money Matters. Thanks so much for watching and do stay tuned. This is NDTV Profit.